Welcome to XM.com for today's Daily Market Comment by Mario Sachikiriakos. I'm Christina Marukos. Another sharp sell-off rocked British bond markets this week, reigniting fears of a debt crisis in the world's fifth largest economy. With investors dumping UK bonds in force again, borrowing costs have spiraled to the highest level since the Bank of England stepped in to ward off a pension fund collapse. However, markets anticipated an extension given the long-term nature of these issues. And when the Bank of England refused, the sell-off resumed with a vengeance. Sterling was quite resilient, losing some ground, but nothing on the scale of the previous bond market storm when it touched a record low against the dollar. This FX calm suggests the sell-off is more orderly this time. Wall Street declined for a fourth consecutive session. The rate-sensitive Nasdaq briefly touched a two-year low as the turmoil in UK bonds went global, pushing yields back to their cycle highs and leading investors to dial back their risk-taking behavior. Some warnings from JP Morgan chief Jamie Dimon that the US economy will likely enter recession and that stocks could fall another easy 20% didn't help. Dimon's warnings echo what the bond market has been screaming for months now, with a deeply inverted yield curve, which is typically a harbinger of recession. Moreover, the big fear around this earnings season is not the results for the third quarter, but rather what corporate executives see on the horizon. Companies have been rushing to reduce their earnings guidance lately, with Nike and AMD, for instance, putting the blame on macroeconomic forces. If this trend persists, the rosy profit estimates for next year could be slashed, raining fire on stock markets that are already on the verge of a breakdown. A trifecta of favorable interest rate differentials, safe haven flows, and an absence of any attractive FX alternatives continues to power the engines of the fast and furious US dollar. Across the risk spectrum, commodity-linked currencies such as the Australian dollar have been demolished by the sharp declines in equities and worrisome news flows out of China. Gold suffered heavy losses too as the rampaging US dollar joined forces with real US yields that briefly hit new cycle highs to wreak havoc in the commodity complex. As long as this toxic combination is in effect and a Fed pivot is not imminent, the path of least resistance for bullion remains lower. Thank you for watching the Daily Market Comment here at XM.com.